What's up guys? So in today's video I'm going to talk about my February 2020 dividend income report. So I'm recording this video guys. There's been a lot of market volatility lately and I've kind of been holding off on buying or selling too many stocks. I don't want to make too many rash decisions. So I'm going to talk a bit more about the market volatility later, but right now I want to talk about my dividend income for last month. So this is my 7th monthly dividend income report since I started tracking my monthly dividend income. And these holdings are between my Fundrise, Robinhood, Stash Invest, and Fidelity accounts. So Fundrise, I hold e-REITs, which are like internet real estate investment trust. Robinhood, I hold mostly volatile growth stocks. Stash Invest, I hold partial shares of certain companies like Apple, things like that. Fidelity is most of my retirement. So let's just check out the numbers, see how I did. For February, I brought in $17.43 in dividend income. So let's just quickly go over the companies that paid me a dividend. I got paid by Apple. I got 79 cents from Apple. AT&T, $2.62. Ford, $8.69. MasterCard, 15 cents. Realty Income, 70 cents. Fidelity Market Fund, 2 cents. And Fundrise, $4.46. So let's just quickly go over some of these companies and then talk more about my buys and sells. So Apple, they recently paid a dividend. I own a couple shares of Apple through I don't know, about a share of Apple, something like that. The stock's been down quite a bit, and this stock will probably get hit pretty hard due to the coronavirus scares. Of course, Apple produces a lot of their iPhones in China. AT&T, this is another kind of a widow and orphan stock where it's paying a consistent dividend, and the company just announced a recent share buyback over the next couple of years. The company just picked up Time Warner last year, 2018, I believe, so maybe a little more than a year ago. And I just like it. It's like an overall conglomerate, and with the new 5G coming out, I think AT&T is well positioned to do well into the future, and they pay a very nice dividend. Ford is actually a position I actually liquidated. So if you guys saw one of my previous videos of why I sold all my Ford stock, I just think the stock's just been tanking over the last 5 to 10 years. The company just doesn't really understand what the consumer's demands are when it comes to electric vehicles. So I liquidated my Ford stock, but I did liquidate it the ex-dividend date, so I received that dividend. MasterCard. These are two Visa, both stocks I would probably hold forever. I'll never sell as well, but I use my Visa card literally every day. So these are kind of just set it and forget it stocks for me. Realty Income, that's another REIT stock that I own. Very nice, consistent REIT. They just recently started expanding into Europe. I think it's very consistent. The money market fund. And finally, Fundrise. Fundrise is an e-REIT, guys. If you want some diversification away from the stock market, I really recommend Fundrise. That allows you to invest in real estate, both corporate and residential, all over the United States. So let's quickly go into some of my buy and sells, guys. So a lot of one of the things I wasn't doing, I wasn't reacting emotionally to the coronavirus news and the scares and everything like that. So a similar scenario, this is back 2008. If you guys remember the financial crisis, some of you guys are so young, you weren't even invested back then. But basically what happened is the Dow Jones dropped from about 13,000 points in August 2007 all the way down to 7,000 18 months later. So we got a major correction. So you need to pay attention to the stock market. This isn't something where you just want to just ignore it or something like that. You definitely want to pay attention to what's going on, because if you're kind of close to retirement, you're going to have to adjust your portfolio, because it could take 1, 2, 3 years to get back where we were, maybe even more. Depending on history, usually the correction, the stock market will kind of regain those losses within a year or two. But if you guys are close to retirement, like less than 5 years away, something like that, you definitely want to reallocate your portfolio, get more treasury bonds, move to gold, stuff like that. Save, safer assets that don't have as much risk. Because stocks, no matter what a stock is doing, it can always go to zero. A company can always go bankrupt. I know some of these large companies are very unlikely to do that, but the possibility is there, so you never really know. So for you guys that are longer term, younger, some of my younger viewers, you guys in your 20s, 30s, and 40s, and you're not retiring for like another 10 years or something, this is a great buying opportunity. At the end of the day, you want to get as many shares as possible. So this stock market correction allows you to lower your cost basis. Some of you guys started investing near the top, where we were seeing like the Dow Jones and Nasdaq, all these companies at all-time highs. Your cost basis is extremely high. So right now you're probably down maybe 10%, 20% or more on some of your companies. Use this as an opportunity to lower your cost basis. At the end of the day, you want to try to acquire as big percentage of the company as possible. And as long as the company is not issuing more shares, every share you buy is going to increase your stake. So what you want to do is you want to get your stake as much as possible in that company if you strongly believe in it. So how do you do this? Well, there's a couple strategies. One of the most popular ones is simply dollar cost averaging. You're not sure where the market's going to go, but you know that you want to invest for the long term. Just continue buying, spending the same amount of money. So let's say you were spending maybe $100 a month on Uber stock, for example. Just keep putting in $100. So as the stock gets cheaper, you acquire more shares. As the stock gets more expensive, you acquire fewer shares. But that'll just keep you consistently owning the stock, and over time your cost basis will kind of even out. And at the end of the day, you're going to have more shares. You wanted the 2008, I had about $50,000 in the stock market, and when the stock market started crashing, I pulled all my money out, and I didn't get back into the stock market well until after the Dow covered all of the losses and went much higher. So for this time around, I'm not leaving the market. I'm going to be in the stock market for hopefully, inshallah, God willing, a long time. So right now, I'm just simply doing what I was doing the last couple years. I'm just consistently adding to my positions, buying more stake in companies that I use. And my new strategy is I'm trying to invest more in companies that I use personally. So for example, companies like Uber, companies like Visa, things like that, stuff that I use every day of my life in my real life. So I'm just continually trying to add to those positions, and that's my strategy. So dividend income it's been started out with basically nothing. I didn't have too many dividend stocks, so now I'm earning about 7% support, which is pretty good. Of course, my long-term goal is I want to get for a fire. So fire, financial independence, retire early, basically where your passive income and dividend expense, say your total monthly expenses are $2,000. If you can get around $2,000 in dividend income, then you no longer have to go to your day job. You can quit your day job. So that's what my goal is with this strategy right here. So I hope you guys find some value in this video. Really take a look at your portfolio and see if you can make some tweaks, if there are some stocks that are too cheap that you can add positions to. And if you're really scared, there's nothing wrong with reducing your exposure and moving into simply safe treasury bonds and stuff like that. So no, it's nothing, or even cash. Sometimes, if you're not really sure where the market's going, it's been up and down. So we had record losses and record gains within like the past couple of weeks, something like that. So it's okay to go to cash. But what I would say is don't pull all of your money out of the market and spend it elsewhere, because that was one of the big mistakes that I made. I simply took the money, to stocks. I bought some things, I went traveling and stuff like that, and then I didn't have the money to put back into the market when, kind of the fear of the financial crisis went away, and people realized that even though, the subprime mortgage crisis was a big problem. People still need to buy toothbrushes. People still need to eat. People still need to put gas in their car. People still need to buy electricity. So no matter what's going on in the world, people are going to be spending their lives buying essential needs, which means that the American economy in the long run is going to do well. And the global economy in the long run is going to do well. The world population is going to continue to increase probably, and people are going to continue to buy more products and services at higher prices. So be confident what's going on. Some of the companies now, these are the best companies that we've ever seen in the history of mankind. So be confident in the stock market. Yes, I understand that the stock market is very volatile right now, but just be confident in it long term. I wouldn't worry too much. What I've basically been doing is trying to kind of nix poor performers, which was Ford for me, which was a huge poor performer. Even though I love the Ford dividend stock, what I simply did is I just simply sold and I bought more AT&T and I added position in Procter Gamble. So I really hope you enjoyed this video. I hope you saying. So if you like this video, guys, please give me a thumbs up and subscribe to more in the future about dividend investing, about independence, retire on the stock market as we're dealing with this ridiculous. You guys are near retirement. You probably in the last major credit stocks lost almost half their value. So if we were to see similar to that all the way down to 16,000, is that your portfolio is going to lose a lot of money. But if you're long term, I would say use this as stop the habit of buying stock term goal. If you're looking for financial freedom, the strategy is keep doing what you're doing. Don't change your habit, because once you stop that habit, it's going to be tough to just restart it back. Be very careful on which habits you are doing, and don't let fear and greed change your long-term goals. So that's a big thumbs up, and subscribe, smash that subscribe button. Until next time, take care.